Well, welcome to our one of our first budget webinars, where we're going to be considering the changes that the budget has made across a variety of different areas of tax. The focus of this webinar today is going to be looking at corporation tax and other areas that will affect our corporate clients. And then we've got a series of other videos that will be covering different areas of tax as well. So obviously this is the first Labour budget we've had since 2009, I would say, so 15 years. And there were quite a few changes that will have impacted across a lot of areas.
Yeah, there were, but also some things that stayed the same.
Yes,
so let's talk about things that have stayed the same.
Well, in terms of corporation tax, we've had confirmed that the rates of corporation tax that we have at the moment are going to be staying as they are until at least the end of this Parliament. So they'll stay at 19% for profits below 50k, and then 25% for profits over 250,000. So at least we've got some surety of that. We know that things are going to be fluctuating.
Helps with planning, doesn't it?
Yeah.
If we know what the corporation tax rates and where those bands sit. So
yeah, exactly.
That's good.
So that's staying the same.
And then obviously we do sometimes get involved with clients who do R&D.
Yeah. So we had announced previously that the two R&D tax relief schemes were merging. That's still going ahead. So we won't have two schemes. We'll have a large company RDEC scheme and an SME smaller scheme. They're just going to be merging the two. So again, it's still a very beneficial relief to be looking at claiming. We do, as Sarah mentioned, we do work and help a number of clients with that. And I've got some good reputable firms that we outsource and use to help us with that.
I think reputable's the key there, isn't it?
It's very important. It is still a hot topic. Unfortunately, R&D was a relief that was abused a lot in the past, and so HMRC have come down quite hard on that with the level of inquiries and investigations that they're making, and also their stance has been quite hard. So again,
I think they've almost gone too far the other way.
Yeah.
So that genuine claims are harder now to prove, and you can almost guarantee an inquiry, and you've got to be ready for it to fight the good fight.
Exactly. So it's still a beneficial relief, but just be mindful the radar is very clearly on R&D relief at the moment. So again, it's making sure that the people that you're using are doing things properly and only submitting legitimate claims.
What about capital allowances? What's changed? What stayed the same?
So what stayed the same is we've still got a surety on annual investment allowance. That's still in place. So £1 million allowance across the board for any capital allowances apart from motor vehicles. Vans, which we'll come on to in a second, can still use annual investment allowance, where you get 100% relief in the year of purchase, up to £1 million. They've also kept full expensing. Now, full expensing is, again, 100% relief, first year allowance, on any main rate, plant and machinery. So again, not cars and not anything that would fall into the special rate. They have still kept as well the 50% first year allowance for special rate items, again, not including motor vehicles.
So let's talk about motor vehicles, because one of the changes that has come is for a certain category of motor vehicles.
So certain category, it's the okie dokie.
Yeah.
Double cab pickups. They were vans, then they were cars, then they were very quickly vans again, and now they are very definitely going to be cars from the 6th of April. So that just means that the way that you can claim capital allowances will change. So from the 6th of April, a double cab pickup will now be classed as a car, which will mean that it will be subject to all the normal rates of capital allowances that cars are. So there wouldn't be the first year allowances. It'll just go into the writing down allowances pools. And unfortunately, due to the CO2 emissions, more than likely it's going to be the special rate. So you'll only be able to claim 6% relief a year.
It's going to be quite a small, small amount compared to what
it's quite a change. What
if I've got, you can say it's transitional.
Yeah,
so if I've already got a vehicle and I've claimed the capital allowances,
you're fine. So they're not doing a clawback, which is good. And the transitional rules are that if you have ordered one, so if you've already got one, that's fine. If you've, say, got one on order now and it was to arrive within 6 months, so maybe just after the 5th of April 2025, it will still qualify for the current capital allowances rules. And that will, generally speaking, that's because the tax point will be when you've put an order in and you've paid a deposit, as long as it's delivered within 6 months, you can count the order date as being the purchase date. So effectively, as long as you've ordered something and paid a deposit and it is going to happen, as long as the final delivery and payment happens within 6 months. So let's say you did it on the 31st of March, so you're looking at the 1st of October, you'll still benefit from the old rules for capital allowances.
Okay.
What I will just caveat, other vehicles that you might think are commercial vehicles, the rules haven't changed there. The rule is that it has to be primarily suited for the conveyance of goods of burden rather than of people. And that's why we've got this change, because double cab pickup no longer has been deemed to meet that word primarily, which is the key, because obviously it can now carry it can carry 5 people in it. So it's not primarily suited for carrying goods.
It's always one that people have to be careful, isn't it? That, I think you can have the same vehicle and a different model will or will not be
exactly. So there are companies out there that will sell, off the top of my head, Land Rover Discovery commercial vehicles. You've got to be careful how the thing has been built. It's more on the way the thing has been constructed rather than what it's used for, which will determine it. So again, if you've got any questions about that, come and speak to us. It's always better to do that than go diving in and then get told, sorry, you can't have the allowances that you thought.
An area that we think knew was going to change and very much has changed then, capital gains tax.
Yeah.
And thinking more in this webinar,
and things like that.
People selling businesses and shareholders. What changed?
Well, I mean, it's gone up, but not as much as a lot of people thought it was going to go up. So the rates of CGT from the budget date, not the day after, but the budget date, are 18% and 24%. And the good news is, though, that business asset disposal relief has remained unaffected for the remainder of this tax year. So if you were to sell shares, for example, that qualified for business asset disposal relief, you'll still benefit from that lower rate of CGT of 10%, which is quite powerful considering now that the main rate is 24%. So you're actually saving at 14 as opposed to 10.
Obviously, Badger's a lifetime limit, though. So if somebody's previously used it.
So if you've previously used some of it, that'll obviously come off your £1 million. Everybody's got £1 million, and you've got to make sure that you do qualify. So the company's got to be a trading company or holding company of a trading group. You've got to have held at least 5% of the share capital, ordinary share capital.
For 2 years.
2 years. And you have to have been an officer or an employee within the group or within the company, for that 2 years at the point of disposal. So again, it's still there. Once we go past the 5th of April, the rate of tax you'll pay will go up to 14% for anything qualifying for BADRA, business asset disposal relief. And then from April 26, it'll align with the low rate of CGT, 18%.
Okay. Sort of linked to that, something I know you guys do and your team is employee ownership trusts.
Yeah. So employee ownership trusts, it's actually legislation that was brought in 2014, but it's recently become more and more popular as people, I think, have understood them a bit more and got their head around how to set them up properly and things like that. The main reason why they become popular is because the tax rate. If you sell your company to an employee ownership trust, you will pay 0% tax, which is obviously very popular.
So that's a nice rate of tax.
Obviously, the government are not stupid. There are a number of qualifying conditions that have to be met and criteria that you have to make sure that the way that the trust is structured, the rules around it moving forward, to make sure that it still qualifies.
I think some of those have been maybe tweaked slightly for the consultation. So let's think about the former owners and their involvement post sale.
Yeah. So normally the way that an employee ownership trust sale would be funded is going to come from cash reserves that are in the company on the day of completion and future profits to provide funding to pay kind of any deferred amounts. So understandably, business owners that have sold to the EOT will usually quite like to be on the trustee board that oversees how the company is run moving forward. That's still fine. However, they can no longer directly or indirectly post-sale control the board of trustees. Normally, the way that we would do it is we would form a company, appoint that as the trustee, and then you'd have a board of directors. They basically now are saying it cannot be controlled by a former owner of the company, which makes sense, really. The trustees have a fiduciary duty to ensure that the company is run in the best interest of the employees. And whilst there is deferred consideration and basically a debt there that is secured, it is in the employee's interest to make sure that gets paid off so that they don't get sued by the former owners. So you can understand why a former owner would want a bit of influence, but they can't have that controlling influence anymore.
What about making sure that we don't pay too much for a company if an EOT's buying it? Yeah,
exactly. With that thought in mind of the responsibility of the trustees to make sure that things are done for the interest of the employees, it's now being set in legislation that they have a responsibility to make sure they don't overpay. So robust, realistic market valuations for the company are going to be needed. More than likely, you're going to probably need cash flows as well to make sure that the amount that's payable on day one and any deferred payments and timeframes for that are affordable and are realistic. Because obviously, trustees don't want to be agreeing to buying the shares on terms that are so unrealistic that could end up folding the company, and all those employees of which they're responsible for lose their jobs. So yeah, it's something that we do on all the ones that we've done anyway, is make sure that we do realistic valuations and cash flows to make sure. So the clients that have done it with us before, well, they're already conforming to this. And if you want to do one with us moving forward, we'll make sure that you've got that in place.
I think a sort of couple of changes that sort of going hand in hand are to do with the clawback potentially of that relief and the location of the trustee.
Yeah. So we won't go into all the qualifying rules now, but if a trust fails to meet one of those rules, i.e. has a disqualifying event, within the tax year or the tax year following the transaction, at the moment it's that 2-year rule, then the tax saved would fall back on the vendors. If it happens after that period, it falls on the trustees. Okay. So what they've done with the changes, they've now extended that 2-year window to 4 years. That's the first thing. And what some people were very cleverly doing was making sure that their trustees were offshore, particularly in places like the Isle of Man, Jersey, where there is no capital gains tax, so that should there be a disqualifying event after that window, there's no capital gains tax. So understandably, the government have said, no, you can't do that anymore. Employee ownership trusts can no longer have or be under the control of offshore trustees.
And then I think there were some clearances we had to go for previously that perhaps now they've incorporated into legislation.
Yeah, so the way that an EOT is funded, generally speaking, comes from funds within the company that are paid up to the trust and then out to the vendor. Those funds, when they move from the company to the trust, are called contributions. Effectively, they're a distribution and should be taxed as dividends at the top rate of tax because it's going to a trust of 39.35%. So obviously that would be prohibitive. So we always used to have to write to HMRC to get clearance that they would accept that contributions to fund an EOT would be not taxable as a distribution. They're basically going to change the legislation to make it clear in the legislation. So we don't have to do another clearance. In fact, there's 2 clearances that we won't have to do as moving forward. If we already have got them in place, and for any transactions that we did, for any EOTs that we did prior to the budget, those clearances still stand, and HMRC will still honour them.
So if somebody's interested in EOT, as you've said, quite a powerful way of saving some tax, obviously get in touch with yourself and the team.
Yeah, we'll talk you through it. It's not for everybody. It might not be suitable for your circumstances or for your workforce, but we can talk you through how it works, all the details. And if an EOT isn't the way to go, or a management buyout might be the way, then we can help you with that as well.
So I think that covers off this first webinar on the budget. Look out for quite a few others covering a range of different topics, and thank you for your time.